Welcome, everyone. Thanks for joining us for today's episode of The Capitalist Investor. You've got Mark and Diamond Hands Derek.
What's up, Mark?
What's up, buddy? How you doing?
I'm not too bad. How are you?
I'm all right, man. Recovering, you know.
Yep.
I've been better, but let's not complain. Let's talk about good stuff, you know?
Absolutely. It's a beautiful day here in Cleveland.
Oh, my God. It's amazing.
We always got to talk about the weather up front.
Well, because we normally just get the shaft.
Oh, yeah.
You know? So it is fun. I'll tell you, man, like, this has been a beautiful spring so far.
Really
now,
has.
I probably just screwed us.
Yeah, you probably jinxed us.
It's going to snow tomorrow. But it's been an unbelievable, and even before spring. I mean, the entire month of March was really nice relative to what we normally get here.
Absolutely.
So let's talk for today's show, D. Let's talk the top 10 retirement tips for 2021. You pulled this off Forbes, and we'll just kind of go through their list and comment, provide our take to our listeners on, you know, whether we agree, disagree, stuff like that.
Yep.
All right. So number one is be ready for early, unplanned retirement.
You know, this tip right here is the reason I picked this article out. You know, I've been fortunate enough to help a lot of people into retirement through the years. And this one is something that has to be on everyone's radar. You know, whether it was, the banking crash in 2008, whether it's COVID, you just never know how long, you know, your current job is going to be there for you.
Yep.
You know, crazy stuff happens all the time.
Plus, I mean, you get to your late 50s, early 60s, you're typically one of the higher paid employees.
Yep, absolutely.
You know? So, I mean, if a business is trying to cut expenses, there's a chance that they may let you go and bring on someone who gets paid half of your rate.
Yeah, absolutely.
You know?
Yep.
And D, we see this all the time. And we used to call this retired by default.
Yep.
Right? You know, clients in their late 50s, early 60s making a good buck, all of a sudden they get let go because of the reason I just mentioned. And then they're so accustomed to making a certain level of pay, they can't get a job anywhere else.
Exactly.
In fact, even if they were willing to accept a job at half of what they were making, people won't look at their resumes and interview them because they think they command a higher pay.
Exactly.
You know, so it's tough, man. But it's one that you definitely have to plan for.
Yep, for sure.
Because it happens.
And, you know, the second reason we picked, this kind of article is because I see these all the time, you know, whether it's on Twitter or, you know, I'm getting hit with ads or whatever, you know, the 7 retirement mistakes to avoid or, you know, top 10 tips to retirement. Yeah, this is a guide. There's lots of good ones in here, and that's why we're talking about them. But, you know, this is really just a start. And coming up with that financial plan to help you get through retirement is going to be very, very important. But, you know, we thought these tips were very good to go along with those, with that financial plan.
I agree, man. Number 2, deal with your debt immediately. Now, I think we need to explain that a little bit.
Yeah.
So first things first, if you look at all of the data, credit card debt is down, like, it might be down around 50% from its peak before the pandemic.
Yep.
It's down substantially. And a lot of that has to do with stimulus money, you know, people getting, I don't even know what the maximum unemployment benefit was. Wasn't it like $50,000 a year?
Yeah, something crazy. It was like it was 600 plus an extra.
Plus whatever you get from the state,
Yeah.
which Ohio, I think, is somewhere around $450 to $500 a week,
People were
something
making
like that.
$1,100 a week on unemployment.
Yep. That sounds right. But credit card debt's down, I don't know, 40, 50%, something like that. And I'm coming up with that number off the top of my head. I don't have the facts and data in front of me. Dealing with your debt immediately, I think, is true, D, if we're talking consumer debt.
Right.
Credit card debt. But if we're talking mortgage debt, I don't see any reason to pay that off.
Exactly.
I mean,
Yeah,
especially if we're talking 3.5%, 4% interest rate. You stand to benefit from keeping your money invested. If you expect your investments to earn, let's just use 7% over the course of the next 10, 20 years, and you have debt that's costing you 3%, there's 4% positive arbitrage by not paying that debt off.
Yeah.
You know? So I think when it comes to mortgages, you let that ride. You don't pay that off. but you pay off debt that's associated with anything that is not an appreciating asset.
Yep.
Is that a good way to summarize it?
Absolutely.
Right. So appreciating asset obviously would be your house. A depreciating asset would be your car. A depreciating asset would be the Louis Vuitton purse that you have in your closet, right? That you bought on your credit card.
Yep.
That's a depreciating asset, right? So I think that's kind of the key takeaway.
Yep, absolutely. And that's probably one of the most common questions that I get asked in client meetings is, should I pay off my mortgage? As Mark said, probably not. But getting all the other debt in line, I've seen credit cards, I've seen crazy home equity lines of credit, getting that stuff in line, very important. And I didn't find 21, but between 19 and 20, household credit card debt was down 9%. Down 73 billion.
Oh, that's weird. I saw numbers that were even that showed it was paid down even more than that. But maybe that's using maybe that includes mortgage debt and card debt and stuff like that. I'd have to figure.
Yeah.
Give me a little time throughout the show, and I'll try to find what I was talking about.
All right, sounds good.
All right, number 3, prepare a health insurance strategy. That's why a lot of people want to retire at 65, because at least you get Medicare at 65. To retire at age 60 and have to foot the entire bill for 5 years, it's tough, dude.
Yeah, that's a lot.
I mean, I know our insurance programs here at work for a family, and I think almost all of us are on our high deductible plans with the HSA. We're looking at like $2,000 a month for a family. It's $24,000 a year.
Yeah.
Well, that's no joke, man.
Yep.
And we're young, healthy, right? Like health insurance is very expensive.
Yep, it really is.
Very expensive. So that's something you got to plan for. According to Fidelity, they estimate that the typical American couple is going to spend almost $300,000 in retirement on things like co-pays, additional premiums, stuff like that. So it's no joke, man, and you need to plan for it, right? And it's almost like when you put your financial plan together. Let's say you have $1 million that you've accumulated. It's almost like you need to move $300,000 mentally, not physically, but move $300,000 of that money into your health insurance bucket,
right? And
then realize that you only have $700,000 of that $1 million left to sustain your lifestyle in retirement.
Yep, absolutely. And I do remember that $300,000 number from presentations I've done in the past. And I also remember when people were surveyed, like, how much is your health insurance going to cost in your retirement? The average answer was $100,000 or below.
Yeah.
So it's a definitely underestimated aspect of retirement planning. I think we use maybe $5,600 per person per year in our financial plan. So make sure you're planning for it, because it's a big ticket item, especially if you want to retire pre-65.
No doubt. All right, number 4, maximize your HSA contributions. We just talked a little bit about this because we have one here at work. The HSA is a cool thing. You get to put your money in as if it were a 401k or an IRA, right? You get to contribute money on a tax-deferred basis. And then as long as you use it for qualified medical expenses in retirement, it comes out tax-free too. It's pretty cool.
Yep.
Worst case scenario, you don't use it for qualified medical expenses, and it's the same as an IRA.
Right.
So
you can roll it over.
You got to max that thing out.
Yep.
So I actually, I don't know how you do it, but what I do with my HSA is I don't spend any of the money that I contribute to my HSA for my annual healthcare costs. I pay those out of pocket with my taxable dollars so that I can keep as much money growing tax deferred as possible.
Right.
What a lot of people do is they'll use that slush fund inside their HSA every single year. But I really think if you can afford to do it, if you have enough money in your checking account, in your taxable accounts, I'd rather see you pay for your medical expenses out of that money and let the HSA grow and grow and grow.
Yeah, for sure. It's almost like similar to the mortgage example we just talked about. But yeah, it really gives you an extra tax deferred bucket, which a lot of people don't know about. So, so if you use it for medical, that's great too. But like Mark said, if you can afford to pay for some of the things out of pocket, that's a real nice extra tax deferred bucket for you.
No doubt. All right, number 5, understand your retirement income options. One of the first things they mention is, when should you start taking Social Security? Yeah. And that's a big one, man. Yeah. A lot of people have that question, and there is the nerdy mathematical answer,
right?
Where we assume that someone lives to be 185 years old, and if someone is able to do that, D, obviously they should wait as long as they possibly can,
right?
But no one knows when they're going to die. Nobody has a crystal ball. So our take on that, D, has really always been, take it as soon as you can,
right?
Because if you don't use it, you lose it, right? Now, I'm not saying if you're still working full-time, take it at 62.
Right.
I mean, everyone's situation is different, right? If you're still working full-time, wait until you retire. But I think you take it as soon as you can, assuming you're retired.
Absolutely. And I've just gone through that with a lot of my clients as we're doing reviews and people getting into retirement. And that's on a lot of people's minds, whether they're clients or just, thinking about getting retired. Everyone wants to know what they should do. It's actually a lot more simple now than it used to be. And when we mentioned the plans a little earlier on, retirement income is basically your retirement plan. That is the number one thing that you need to get in line, because when those paychecks gets turned off, we need to know where the income's coming from. So hopefully Social Security is just one part of that overall plan. But like Mark said, it can't just be a mathematical calculation, because most people are going to have multiple income sources. So make sure you're taking all that into account when you're making those decisions.
Yep, no doubt. All right, number 6 is practice retirement spending now. That's not bad advice.
It really is a great piece.
If you intend on living off of 80% of your income in retirement, why don't you give that a whirl for 3 months and see it? Honestly, see if you can do it.
Mm-hmm.
And if you can't do it, then you need to redo your plan and assume that it's going to cost you 100%.
Yep.
And then maybe you have to make a decision that you got to work an extra year. But I like that. I like giving it a test drive.
Absolutely.
See if you can tighten your belt buckle.
And as Mark mentioned a little earlier on, you don't always plan to get into retirement how it actually happens. So you can get forced into it somehow. But typically at the end of people's careers, they're making the most amount of money they've ever made. They don't really have to worry about a budget. But in a retirement plan, knowing your budget is a really, really important piece, because we're going to use that overall budget to kind of project what you're going to spend going forward. I've done hundreds of retirement plans, and I can't recall one ever getting executed at 80% of expenses.
No.
And that seems to be the prevailing number out there.
Why is that?
I don't know, but it's always out there.
I would actually say our clients, for the most part, they probably spend more.
Absolutely.
So we tend to attract clients who are more active, who want to enjoy their lives.
Right.
I don't know how that happened. Maybe it's because we're such cool people.
Probably.
It's got to be it. We tend to attract those clients more so than the homebodies who, really, don't spend a dime. Right. And for our clients, and I'm not saying we don't have those clients, but for the majority of our clients, they spend more money in the first 10 years of retirement than they did while they were working.
Absolutely.
Because they want to ramp up the vacation, travel, and stuff like that.
Travel to see the grandkids.
If you think about it, if you retire at 60 or 65, whichever age you pick, I mean, don't you want to kind of front load your spending?
Yeah,
when you're the
absolutely.
healthiest and you're most vibrant and able to enjoy it.
Mm-hmm.
Do you really want to pinch pennies early on so that you can have more money when you're 89 years old?
No, definitely not.
Yeah, it doesn't make sense to me. So I like the whole trial and error thing. See if you can do a test drive and reduce your expenses.
This is a great piece of advice. I really like that.
Number 7, did you take out a coronavirus hardship withdrawal? I hope not.
Yeah.
I hope not. I mean, if you did, there was probably a good reason to do it.
Mm-hmm.
And you probably just didn't wait until all the fiscal stimulus dropped in your lap.
Right.
And the crazy $1,100 a week of unemployment. So I hope not very many listeners took out a coronavirus hardship withdrawal from their tax-advantaged accounts.
But if you did, I think you could take up to $100,000, and you just have a longer period of time to be able to pay that back.
Yeah.
So, and I believe it's up to 3 years.
Yeah, and let's keep something in mind, D. You took that hardship withdrawal when the S&P was trading at 2,300.
Right.
Now you're going to put it back in the market with the S&P trading at 4,000.
Right.
I hope you didn't do that. Mm-hmm. Seriously. All right, number 8, reassess your post-crisis risk tolerance. I don't think anyone's risk tolerance, actually, everyone's risk tolerance is more aggressive. That's bad.
It is. And I'll be honest with you. It was not good last March and April. And I barely got any panic phone calls at all.
Yep.
I would almost say people's risk tolerances have gone up.
I think so.
In a pretty drastic way.
Possibly an unhealthy way.
Right.
Last year was an anomaly. That's not going to happen every single year where you can pick a stock by throwing a dart at a dartboard and it's up 50%. Mm-hmm. Valuations didn't matter last year until all of a sudden they mattered again this year.
Yep.
You saw interest rates going up, stocks that were trading at ridiculous multiples started to pull back.
Right.
So reassess that. And I'm not saying reassess from where you were before the pandemic to right now. Reassess from where you were December 31st of 2020.
Right.
You're probably overly optimistic. Mm-hmm. You're overly aggressive.
Right.
Time to get realistic.
Yep. I think, real quick, I think we're finally headed out of the phase where everyone's just trading on news. And when cases go down, the stock market goes up. We're, like Mark said, we're about to get back into, valuing companies based on what they're worth, based on what they produce. So there will be a reckoning for that. Nothing crazy, but some of these overpriced stocks are going to get chopped down a little bit. So not everything. It's not realistic to think you can pick out a stock and all your picks are going to be up 50% in the next month. So just temper your expectations a little bit and make sure you're comfortable with your overall risk allocation.
Exactly. Number 9, consider part-time work for retirement. That's definitely a bridge solution to get you to where you need to be. Because sometimes like people are working jobs that just beat them up.
Right.
Maybe your boss sucks. Maybe you got to wake up at 4 a.m. because you got to be in the office at 6 a.m. And you just don't want to do that anymore.
Yep.
Maybe you're in a physical industry like construction and your body's getting beaten up doing that. So, look, it happens, man, where your financial plan says you need to work until you're 65, but you're 58 and you're sitting there and you're like, dude, I'm destroyed.
Right.
I got to get out now. So I like this idea as a way to bridge that gap, right? Retire, but work part-time until your plan says you can fully retire.
Yep. I don't really have anything to add to that. You pretty much hit it perfectly.
Thank you. On to the next one. Number 10, should you postpone your retirement? I hope not.
No.
Yeah, do it now.
Yep.
Obviously, this is where you need a financial plan.
Right.
You need to figure out what your financial plan says. And there's always options, man. You could tighten your belt buckle in retirement. That would not be my preferred option. Okay. You can work longer. If I'm 65 years old and I had my sights set on retiring at 65 and someone told me I had to work until I was 67, I don't think I'd like that option either.
Right.
Then there's the part-time work option that we just mentioned. That would probably be my go-to, right?
That's a good one.
I'd want to retire now rather than working full-time for another 2 years. I'll work part-time for the next 5 years, doing something I enjoy just to stay busy, 15, 20 hours a week.
I just met with a client 2 weeks ago. We executed that strategy and it worked perfectly for him.
Yeah, right. So that's a way to bridge the gap. But when you're thinking about retirement options, I think the key here is to understand that there are options.
Yep.
You don't have to do one thing. You don't have to postpone. You don't have to cut back on your expenses. You don't have to work part-time. You've got options. And you need to figure out which option is going to work best for you.
Right.
Right. I told you my preferred option. Maybe you're in the camp of cutting expenses or working longer. But you definitely have options. All right, that wraps up today's show. As always, thanks for joining us. Hit that subscribe button. Give us a 5-star review. Write us a review. Shoot us an email at info@swpconnect. We'll see if we still have some hoodies around for you. I know we do. We're running low on a few sizes, but get your hoodie while you can.
It's awesome.
Yeah, it is good swag. All right, everyone, thanks. We'll talk to you next week.